Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwan index that's opened up with a decline of 0.5%. Hang Seng down 0.4%.
Both leaders also formally announced the finalization of terms of reference for the bilateral trade agreement.
So the upside level for the Nifty is 24,546.
That UBS is buying 4.95% stake in 361.
First rates 24,170 on the Nifty, 55,428 on the 55,300 plus on the Bank Nifty as well.
Markets can digest good and bad news, but uncertainty is something that it doesn't like.
Nifty is now closer to 24,250. The Sensex is at 79,800.
That the wealth management, seen in India is really, growing at an exponential rate.
Could see their pictures touring the fort, and they were welcomed in a traditional Rajasthani way.
AC manufacturing companies have seen quite a sharp spike. Names like Voltas, Havells, Blue Star, all of these stocks doing quite well in the session.
Well, that is the day so far, and it is actually a pretty decent session all told. It's quieter, much quieter as compared to the last few days. It's been absolutely boom, boom. Today it is not boom, boom, but it is softer boom. I guess this is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. Surabhi is with me here in the studios, and Nigel is joining us from the newsroom floor. Rima should be with us shortly as well. Guys, hi, afternoon.
Hi, good afternoon. I think the markets will take the softer boom. Prashant, it's not too bad, right? We've been outperforming global markets throughout this rock and roll month of April, Liberation Day and whatnot. The markets come off, it's done a great job at a recovery. We're above our moving averages, and even after yesterday's rocket move, the market's held its own. And today it's more about mid-caps, more about individual stocks that are moving higher. So soft boom, looking good.
So tomorrow, if the Nifty is up 1%, you'll call it?
One doesn't do. One is not boom. You need at least two. But anyway, I mean, it's, as Surabhi said, it's 1% of the mid-cap index. It's 1% of the small-cap index. Nifty is up just about 0.25%. So there is that. Of course, Nifty is up 10% in the last 7 trading sessions. Nifty Bank is up 12% in the last 7 trading sessions. So there is, a fair bit of run which has happened from the lows in early March. So, you got to keep that in mind. In any case, it's turning out to be a pretty good start to the week. We're still in the early stages of the week, but it is pretty good. Lots to talk about in terms of individual stocks in a couple of sectors as well, and we'll do that. Bank Nifty, by the way, is still up 0.8. So that is, of course, the first index yesterday to make a new all-time high. Those LCR norms are helping, and we've got an interesting discussion coming up with the Federal Bank management on implications as they see it coming through. 55,740 on the Nifty Bank.
Well, it's the PSU banks.
Before you talk about the reaction, I think it's the tie. It's a pristine green tie, very nicely centrally located, in sync with the market's move today. Nice strip of green there.
Well, it's the PSU banks actually, which are doing much better. The PSU banking index at one point of time was up nearly 2%, now up 1.25%. But today you've got FMCG participating. Yesterday, while all the sectors did well, FMCG was lagging. But today you've got strength in ITC, HUL, Tata Consumer. Tata Consumer reports numbers later this week, and today there is strength in the FMCG basket. You call it the normal, the expectedly normal monsoon this time around. More money in the hands of consumers on account of the budget. But FMCG is a pocket of strength. HDFC Bank continues to gain ground. It was up nearly 2% yesterday. It's added on another 1.2%. SBI is higher, and M&M is on the front foot. On the way down, it's Innocent Bank that continues to be the top laggard, 4.5% lower. IT is giving up some of the gains from yesterday. Infosys, Wipro under pressure. HCL Tech, remember, reports numbers later in the evening. Bharti Airtel, which has been a rank outperformer with a 40% plus return in the last 1 year, is seeing a bit of profit booking. And two-wheeler names, Hero and Bajaj Auto, down 1.5%, 2% on the back of the Jefferies downgrade.
Yeah, that's definitely it's weighed on these stocks, the two-wheeler names, Bajaj and Hero, throughout the session today. The broader market, let's focus on that because that's where you have a nice flurry of green and stocks are moving to either individual earnings or individual news flow. Now, case in point would be something like, let's say, Dixon. Dixon seems to be quite excited because there are reports suggesting that some of those supply chain shifts when it comes to high-profile mobile items like iPhones, perhaps that could be coming in the weeks and months ahead. Apple could reconsider its supply chain alignments, and that seems to be working well for that stock. Data patterns, you'd remember yesterday, Nuvama had initiated a positive report, a buy rating on a bunch of defense stocks, and data patterns was one of them. It seems that there's follow-through buying on names like this. Puravankara up 10%. We spoke with the management earlier in the day. Business outlook seems, quite robust. So that's up and about. There are names like Wari Energies, where the fact that the US perhaps is not going to be importing more from China when it comes to solar equipment, renewable energy equipment, that seems to be, adding to a nice green sentiment on these stocks. And by the way, look at the wealth managers. Let's not take our eyes off it. In the morning, these stocks started a little subdued because they've rallied a lot. But look at them now. Look at Motilal Oswal, 4%. Look at 361 Wealth Management, where the deal with the UBS has happened today. Stocks now at the day's high, almost 3.5%, 4% higher. That's Motilal. Let's pull up 361 as well. And even Angel is finding some traction. Yeah, look at a big spike on 361. So this is a very, very hot space. We'll talk about this as we go forward. But wealth managers definitely in focus. So what should you be doing in the last hour of trade? As always, let's ask Mitesh for some advice. Mitesh, so index has been a little quiet and range bound today. Lots of stock specific action. What are you going with now?
Yeah. So I think, actually the index, the way it's run up, I think, not surprised that there will be some profit booking or some supply happening at higher levels. The call writers would be fighting to protect 24,200. That's an important level. And then 24,500, 550 is the zone. So I think maybe some stocks will play catch up, especially the ones which have been sideways consolidating and are breaking out right now. One of them is Max Health, which has come on radar. That's a buy of the stock below 1100 for targets of 1180 to about 1190 on the upside. And the other one is Mahindra and Mahindra. I think, again, a stock which is not participating in the last few days has started picking up. And today has given a clear breakout. So buy here with the stop at about 2780 for targets of 2880.
Yeah, big move on M&M today. Thank you very much, Mitesh, for joining in. Let's talk about Innocent Bank. In the morning, there were reports that ENY, the bank has appointed ENY to conduct a forensic audit of the microfinance book. Ritu has now picked up some more details on that because this has been weighing on the stock. Ritu.
That's right, Rima. We've been able to confirm some of the reports that emerged this morning that IndusInd Bank has indeed appointed Ernst & Young to carry out a forensic audit of its microfinance portfolio following the discovery of a near 600 crore discrepancy by its auditors. The issue, we understand, is related to the accrual of interest income, which relates to the microfinance book and is believed to have emerged over the last couple of quarters, that is the second and the third quarter of FY25. Now, while the bank has not made any disclosures regarding these discrepancies, which we understand it has been in talks with the regulator for, what the bank has done is set aside some provisions, again, not call them out as provisions for these discrepancies, but the bank nonetheless has been making these provisions. We understand these provisions have been drawn from the contingent provisions of the bank, which stood at about 1325 crores as of the third quarter, down from about 1525 crores in the previous quarter. Now, their micro loan book, that stands at about 32,500 odd crores as of December, and the bank had also reported about 300 crores, in new stress formation and about 344 crores in write-offs in the microfinance finance segment alone in the third quarter. So more trouble brewing for IndusInd Bank, yes, and the audit is going to reveal the extent of the issue. We have reached out to the bank for a comment, which is still awaited.
Thank you very much for that. IndusInd Bank has also had a phenomenal run in the last 1 week, where the stock has gained close to about 20%, so some profit booking also visible. Gurmeet Chadha, Managing Partner and CIO at Complete Circle, is now with us. Gurmeet, how have you read the developments that we've seen on IndusInd Bank? The stock initially nosedived, it started recovering, and now this.
In banking, we always say there is never one cockroach in the kitchen. And once stress builds up, it builds up, and there's nothing against the management of the bank here. I think it's just that maybe to give a more positive response. I think they're themselves initiating. Probably there's a bit of a cleanup happening now, and there could be a bit of RBI intervention also on that. So probably they want to start, with addressing all possible concerns, and that's why probably proactively taking it. And microfinance was one part of the portfolio which was reason for its underperformance before the FX loss and the derivative issue came forth. And this has happened with earlier also. Whenever a bank does clean up, we saw that with RBL also, Rima, when they had issues in credit card and unsecured, the stock underperformed and it's still trying to recover. So, once you get a bit of a, bank business is leveraged. You take ROAs of 1.5%, 2%, and you leverage it 6, 7 times, and then you calculate ROEs. But if asset quality comes under question, the street would not assign you a 3, 4 price to book multiple, which it will assign to pristine asset quality, which it does to others. So I think it's more in terms of what a multiple a bank gets. It's a function of the quality of the asset book, and I think these issues will take a little time to fix. And RBI is doing so much for banking. They've done away with the liquidity coverage ratio. The runoff percentage has been given some waiver. So there are a lot of other opportunities in this space other than to just pick point one and see if there are any bargains left.
And we'll, of course, keep an eye out on that one. Stock, of course, has done well, right? Now 15% with today's 5% drop. Otherwise, it was kind of sort of going one way over the last 4-5 odd trading sessions. Gurmeet, there are, for many, and in the mutual fund space, this is what has happened in the market in the last 5-6 days is a real pain trade, because there are a few who are sitting on a large amount of cash who didn't come back in as the market started to reverse. So, it's and you got to, if you're managing a large amount of money, you can't flip in and out, right? You got to take a decisive call, in or out. And that's the problem. What is your sense? Is the market kind of, we've gone from being absolutely despondent to thinking everything is fixed. A little overdone on the other side as well now?
Prashant, it always happens. The easier part is to take a cash call when things are not going your way. The most difficult part is to get back in. I know so many clients, with personal experience who probably some of them even got COVID right, but they weren't able to get back at 7,000, 8,000 at the Nifty. People were then waiting for 5,000. Similarly, people were right now waiting for 19, 20,000 on the Nifty. And I personally believe in, principally speaking, and each to his own, fund manager job is not to take an asset allocation call. The asset allocation call has to be at the client level. He is giving money for equity to you. You're not supposed to take large cash calls. See, some bit of it is fine. You rotate, you keep some cushion, 5-10% cash calls are fine. To take large cash calls, because you're not running an asset allocator fund. You're running an equity fund where the mandate is growth. So to me, principally, that's not on. That's the job of an advisor or the client. I personally think that the market will probably now wait for earnings. I don't think so it's overdone. In fact, I spoke to you that market looked oversold at those levels because there was too much negativity and India had very little role there. And now once the market realizes that probably you are not uniquely disadvantaged and has some advantage, you see a bit of covering. And this K shape, W shape, we keep listening. Market is always V-shaped. When it recovers fast. We have seen that so many times. So, just stay in the game. I think the only thing you should do is, keep rotating. I think what market is not telling you is that keep booking mistakes in this upside. If you have previous mistakes and you're getting good exit points, do that. Be a little more conservative and moderate going forward.
I like that. Gurmeet's phrase, you're not uniquely disadvantaged. You're not uniquely advantaged, also maybe uniquely advantaged. I remember that.
It's relative to these days.
No. But I think, point taken, and that's it's each to his own, as you said, right? But it's a debate. It'll never go away, I guess. There are those who believe on the other side as well, but the arguments on both sides. What have you been doing, Gurmeet, lately? We've spoken about lots of stocks, etc. But, stocks have snapped back, 20-25%. What have you been doing?
I heard this term, I think, Prashant, somebody speaking to you, I'm forgetting the name, it's called trade nationalism. And I think that is what we're going to see now, going forward. So I think everything would be more inward, domestic looking, which actually means it's good for, domestic manufacturing, commodities, cement, and somebody also said it could be from NASDAQ to Dow Jones now. or from the main street to the Wall Street to the main street. I think increasingly, you will see now more focus on jobs, more focus on the lower strata, more focus on blue collar jobs, and this will happen with governments all across the world. Complete spending on defense. So we added some defense names when we last spoke. I think banks were very juicy when they were at 48, 49,000. So we went overweight financials. We are now adding some more names in energy. I think so. We're looking at demand where earnings are not very cyclical. There is some secularity on earnings. So energy is one sector where both in generation and transmission, we see some secularity in earnings. Telecom is another sector. You will not see much variation. You have basically 2.5 players now. And your two players now increasingly gaining market share, better ARPUs, and pivoting in terms of digital and other offerings other than mobility. And we are adding some niche names, like for example recycling, which to me is a huge billion-dollar opportunity considering the global waste management is $600 billion. We are hardly $10-12 billion. And little bit dibbling into autos. I think that there is a lot of negativity in the price. Both in terms of OEMs and auto components. So we are selectively dipping in there and gradually will build exposure over the next couple of weeks.
Okay, all right, got that. So autos, maybe even OEMs and niche plays like recycling. Got it. Interesting ideas there, Gurmeet. Well, Gurmeet spoke about financials and that is one of his top picks as well. Let's talk about the latest move, which again is a shot in the arm for banks because it's a big relief coming in from the Reserve Bank of India. Now, yesterday, the RBI clarified that the liquidity coverage ratio norms, the final norms that are coming in, will be a little more flexible, less onerous than the draft that was proposed a couple of months back. To talk about this, we have Harsh Dugar, Executive Director at Federal Bank, joining in. Mr. Dugar, thank you very much for taking this quick call. So the RBI itself outlined that once these guidelines are implemented, from the 1st of April 26, the impact, I think, is going to be 6 percentage points in terms of overall LCR. But you tell us the fact that, now these norms, this runoff rate, as it's called, it's not as high for wholesale deposits. Even for the internet and mobile banking, it's not 5% as was proposed, it's 2.5%. So how does this impact your operations and liquidity?
See, I'll comment on the banking sector as a whole. As has been mentioned, there has been obviously a couple of things. Earlier, it was anticipated that the higher runoff rate would be at 5 percentage points for the IMD segment, which has now been done at 2.5%. The biggest benefit which is coming in is a substantial reduction in the runoff rate for non-financial operational deposits. That being brought down from 100% to 40% is going to provide significant liquidity and reduction in the requirements because, as was mentioned by RBI in this thing, that it will actually increase the LCR from the present from 100 to 106%, which was earlier anticipated to go down to 90% as per the draft guidelines. So that's something which is going to be a fillip, and that will obviously provide significant liquidity, about 2.5 to 3 lakh crores is what we were anticipating, which will aid the credit growth as well. So it's a big plus for the segment as a whole, and it is becoming effective from 1st of April 2026. So that's something which I think banks can, in general, look forward to a higher liquidity to manage growth and support credit growth.
Okay. Harsh, hi. So have you done any analysis for Federal Bank? And first, if you could also tell us, what is your share of wholesale deposits? What's your current LCR? And now with these relaxed norms, what would be the incremental liquidity which is now available for you, perhaps to lend?
So we are in a silent period, and I would like to avoid any questions which is pertaining to the bank in particular. To the segment and about the guidelines we can comment on. So I would request you on that part.
Okay, so this 6% increased liquidity now, which is available to the system as a whole, what would be the incremental lending that will happen on account of that?
Yeah, so if you look at it, the credit growth is expected to be supported to the extent of about 1.5 percentage points, which is significant because considering that we were talking about earlier liquidity in terms of an issue for deposit growth. So this will indirectly help in terms of supporting credit growth. So broadly, the 6 percentage points savings in the LCR, which RBI commented on for the system as a whole, will result in some liquidity being released to the extent of about 2.5 to 3 lakh crores, which in turn will aid credit growth by about 1.5 percentage. So that's for the system as a whole.
So 1 to 1.5 percentage boost to credit growth system-wide, you'd say, yes, from next year, right? Which is when these norms come into effect from 1st April 26.
Absolutely, from April 26.
Okay. I mean, 1.5% additional credit growth. I think the market will like that. Mr. Dugar, just before we let you go for this year, because we're going through bank earnings, and I mean, the big chatter on the street is everything else is fine. When will growth pick up for banks? So just broad thoughts very quickly on this.
So yeah, there's been a little bit of a muted growth in terms of it, but we're anticipating that will come back. There are obviously uncertainties because on account of the tariff wars which is going on, the uncertainties on account of that has definitely muted if you look at the wholesale the credit growth outlook. But if you look at it on the retail side, people do see that this growth may come back during the course of the year, whether it's microfinance, and yet people are talking about it bottoming out in Q1 and Q2. So you'll see this coming in. Unsecured loan growth, which was muted last year, may also revive. So overall, yes, we are still guiding for 11 to 13% for the system level is what we are looking at, the system as a whole.
11 to 13% system-wide growth this year. All right, Mr. Dugar, that's helpful context. Thank you very much for that perspective. Good talking to you. And of course, we'll discuss the bank-specific questions once the results are out. That's Federal Bank on the latest moves on LCR from the Reserve Bank of India. That's banking. Gurmeet, the one sector I wanted to take up with you before we let you go is EMS. We've discussed this in the past. I mean, you've always told us you like Dixon. The stock's always been expensive. Let's pull up the stocks before I toss this to Gurmeet. Dixon is just one. I also looked at a smaller name like Avalon Tech, another EMS player. Stocks up about 9%. So there's a lot of selective buying going on in this whole EMS side of the market. Anything that you would buy here, Gurmeet, now after the correction?
I think, Subi, one learning is that you should focus other than fundamentals on where the government is wanting money. So if you see 22, 23, nobody would have thought that PSUs and defense would lead the rally. Similarly, we saw maximum PLI in electronics. And I think that's why I'm saying these trade deals have to be very closely watched. We are moving into a multipolar world. We'll probably see in the next 90 days, a lot of trade deals. The sense we are getting in terms of speaking to our clients is that there are clear areas where government sees an opportunity. Pharma, textiles, PLI would be enhanced in electronics. But I think electronics, most good news is in the price. I mean, you are not going to make much money entering Dixon at 16, 17,000, at least in the near term. I may be proven wrong. Pharma, auto. So you'll see a lot of these deals getting staged. And I think there's a lot of spaces China will vacate because it has also moved up from 3,000 per capita dollars to 11, 12,000 now. And we are still at about 2,000. So, toys, leather, bit of textile. So as I said, a lot of focus will come to generating jobs. And that's one concern government has, which is the jobless growth. And a lot of sectors which are labor intensive might actually gain, but you probably need to wait it out a little bit.
Fair enough. Gurmeet, good conversation as always. And I'm sure as a business owner yourself, you've been watching what's happening in the wealth management space closely, the recent transactions.
Absolutely.
So that's absolutely exciting. That's another conversation. Thank you very much, Gurmeet. Appreciate it, as always, here on CNBC. We'll take a quick commercial break here. We're going to come back and we will connect with Rupen Rajguru from Julius Baer on the other side. Stay tuned.
Welcome back. Markets have come off a tad bit. The Nifty is now at 24,150. The day's high today was 24,250 thereabout. So we've slipped a bit. Even the Nifty Bank At session highs, it was up close to about 750 points, 750 points, now up nearly just 350 points. Some of the drags today outside of ICICI Bank and IT names, Power Grid. Power Grid is a bit subdued in trade. Coal India and Adani Ports are some of the names where you are seeing incremental pressure. ONGC too, now down close to about 0.5%. Rupen Rajguru, head of equity investments and strategy at Julius Baer, is now with us on the show. Rupen, hi, afternoon, and thanks for joining in. What's the outlook now on the markets? We've seen the markets correct sharply in the early part of April and bounce back equally sharply.
Yeah, hi, afternoon, Rima. So you're right, we had a big yo-yo in the market, specifically in the month of April. And India probably is one of the few countries who is, YTD now is giving positive returns at a Nifty level, while mid and small caps are still lower. If you look through, Rima, Indian markets actually, if at all we were to use that term bottoming, we did not, when this tariff tantrum came into the picture, we did not breach the previous low, which was closer to 21,800. So now probably in hindsight, we can say that was the bottom of the market, and that was before all the tariff related news came into picture. So why were we down? Because we had corrected before all these global issues, because the earnings were slowing down and the economy was slowing down. So what we believe that now we are entering a bit of cyclical recovery in macros. So in India, what we believe is the government capex, which first half of last year, if you recollect, because of election was not there. So probably this year, the government will front load the capex. Secondly, the RBI has been pretty supportive for growth with rate cuts and a lot of other measures. So RBI also wants growth. Plus monsoons are also going to be good as per the early indications. And also the effect of the tax cuts will come into picture from 1st of April onwards. So all in all, we might be seeing a bit of cyclical recovery. So from a market perspective, unless something on the global scale, which as of now you and I can't predict happens, I think we are pretty constructive in the medium term as far as market is concerned.
Rupen, run us through some ideas. That's stocks where you think there is still opportunity, because stocks have snapped back very quickly, and before you can say anything, I mean, valuations are in many cases without any incremental change in earnings or anything, or maybe it's all, of course, based on what future projections will look like, but nothing is very meaningfully changed. It's looking better generally, but it was we always knew, right? I mean, maybe second half of as we get into the thick of the new fiscal year, things will get better because of easier liquidity, etc. Where do you think there is still sort of serious value price dislocation, which one can take advantage of?
Sure. Yeah. Hi, afternoon, Prashant. So this market definitely is going to be a difficult market because we are not in an era of as you rightly said, there were sharp moves on the downside and equally sharp move on the upside, and probably we are back to where we were. Here, the pockets of opportunity would come through in some of the segments. I've been saying this on your channel for quite some time. BFSI as a space has been looking good and actually has been one of a better performer in last few quarters. Within BFSI, while the top 3-4 banks have done well, what we believe now that since the overall credit cycle is or the NPA cycle has been pretty stable, credit cost has been pretty benign, and liquidity coming back into picture. So some of the mid-tier banks, also specifically some of those banks in which we have seen a change in management, and some of the KMPs from a large bank has joined as a CEO of those new banks. Those we believe might be a good turnaround candidates and are ripe for a re-rating. Some of the other segments, as I said, consumption, specifically on the low-end consumption, we believe, as I just explained about some of the tax measures will come into play, rural recovery thanks to monsoon, and also the inflation is benign, and for the first time in 3 years, the real wage growth, specifically for that daily wage earner, is going to be positive. So the low-end discretionary consumption will clearly be a winner, and those segments have been ignored by the market. So be it footwear, apparels, QSR, liquor, all those segments, definitely we find opportunities there. And amongst a contrarian, not contrarian, but one sector which probably again on a YOY basis would see a better year next year is going to be cement. So that is one segment which we believe should do well. So these are some of the ideas which we are looking into. But yes, at an aggregate level, there are not many value opportunities, so to say.
Would you call IT a value opportunity? Because you like large cap IT and you've liked it, you've been constructive on it for a while. So a few questions here. One, did you ride the downturn in IT over the last 3 months where we saw IT stocks correct nearly 25%? Two, are you buying at these levels? And three, what kind of a return can IT stocks give? Even if they're attractive valuation-wise, there is no growth. So in the absence of growth, and if we have about a 3, 4, 5% kind of a growth, then what kind of a stock price return should we expect?
Sure. So, Rima, in fact, we had significantly reduced our weightage in IT towards end of last year, and we have been underweight. And as we speak today, we are considering the kind of fall which we have seen in the stock prices. We are more constructive on IT as we speak. And if you look through, IT has a very strong correlation with IT index with Nasdaq. So historically, whenever Nasdaq has done well, IT has done well, and vice versa. And this year, Nasdaq is down, and IT also index is down. That's a strong correlation. And IT as a sector, in fact, large cap ITs, if you were to just do a YOY or calendar year calculations, the differential between the 52-week high and 52-week low for IT stocks is one of the highest. So be it the large names also, typically we see that 20, 25, 30% movement between the lows and the highs of the year. And that's always happened. Why has it happened? Because obviously because of the news flow. And as you rightly said, currently we are in a IT down cycle, so to say, and probably in a US down cycle. So from 92 till now, there have been 4 or 5 US down cycles. And so far, there hasn't been a single year in which the IT has degrown. So coming to the current scenario, what has happened? Yes, all the headwinds, what you articulated, is there and to some extent is known in the price. IT stocks are pricing in a significant US slowdown, if not recession. But now at valuations, so a lot of these large companies, and typically all the IT companies are a classic, I would say, mature industry, which, as you rightly said, growing at 4-5%. Probably this year might be lower and next year might be slightly higher than that. With an 80% on an average payout, when you go below 20 PE, your overall dividend yield or FCF yield works out 4 to 5%, depending on what kind of valuation you are trading. So in an environment in which we are, while we have seen a good rally from the lows, but globally still things can be murkier. So if one wants to play defensive, probably the maximum negative news is more or less there in the IT. And it would be a good defensive bet, and that 4% dividend yield, and if it falls further, 5% dividend yield for those stocks. And historically, we have seen stocks bouncing back from here. So sorry for the long answer, but we are constructive on large cap IT names at the current juncture.
Okay, I wanted to ask you, why not mid-cap IT? Because that is where the growth is, right? I mean, large cap IT is growing at 3-4%, but you got companies like Persistent, Coforge, which are growing very, very strongly, 25, 28 times earnings FY27. But that is for our next conversation, Rupen. Thank you very much for joining us. Good speaking with you and appreciate your time here on CNBC-TV18. We'll take a quick commercial break here. We're going to come back with what's happening in dealing rooms. So Nimish will help us with that, what's on his chatter list today. And of course, some short-term trading ideas coming up as well.
how do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account. And the person did not even kind of entertain me. So I was in chappal, and as a student you go there and so kala come to and so on, and then after conviction, after some convincing, fill the form, 2 days, 3 days, and open my account. By the time you're gone, your interest is lost. So the point was you find one problem area at a time and then kind of figure out that you have this right to win in this market.
What your data is telling you at this point in time about the investing culture?
Mutual fund used to be very low, by the way, in low single digits. And now it is at high single digits. Stocks used to be high single digit and it's slightly higher single digit. Indian middle class, very large, and we are at around the 70-80 million mark.
What are the top 3 things that you will never do?
We will not do e-commerce, unregulated products. We will not do anything which is not good for the customer.
I can. Yeah.
Welcome back to the markets. Keeping it fairly steady at this point in time. If you look at the Nifty, gain is still about 45 odd points. Midcaps are still up about 1% or so. Nimesh is back as usual from, with all the dealing room buzz and chatter. Nimesh, it's a slightly quieter day. Bulls seem to be digesting their winnings of the last couple of sessions. What have you picked up?
Well, Surabhi, it may look a quieter day on the Nifty, but there is a lot of action in the broader market stocks. So again, the mid and small cap indices are outperforming. A lot of individual stocks has started seeing a bit of buying traction as well. The one sector which stands out in terms of buy flows is the consumption names. All the consumer stocks are again very well bid. So you'll see a slightly higher FI figure, largely towards the consumption stocks. Look at the ITC, for example. The volumes today is the highest in last 3 months in ITC. So that's a kind of delivery which is getting marked for the consumer stocks by the larger institutions today. Again, financials are doing good thanks to the further liquidity ease by the RBI. But within the broader sectors, I spoke about consumers, banks doing good. PSU as a theme is again catching a lot of attention, not only from institutional investors but from larger HNI investors as well. So again, that's one pocket which is selectively outperforming, which is the PSU basket. Today, for instance, all the PSU banks are also well bid by large institutions. Technically, now I think the big resistance is now turn out the support. So 23,800 will act as a very strong support on the downside, at least in the near term. And the feedback is that given the kind of FI flow and newer sectors participating, the momentum can continue both on the Nifty and on the Nifty Bank.
Oh, absolutely. Nimesh, markets full of deals, chatter. So let's get to the meat of it. What are you picking up?
Well, Prashant, I guess deals are on, so that's going to happen. But there is a lot of buying interest as well into individual stocks. The first stock on my list is Federal Bank. Looks like some bit of accumulation is happening from very long-only funds into Federal Bank at current levels. So the delivery marking is quite high, and that's the trend in today's market as well. So that's the first stock. The second stock is KEI Industries. This is interesting. We saw a sharp derating for all those polycaps in KEI Industries, and at these levels now, a couple of AIFs and domestic AIFs have been accumulating at these levels. So that's the second name in my list. third couple of PSUs, I spoke about broadly the PSUs being well bid. Canara Bank and South Indian Bank, these are the two names within the PSU bank stocks which are very well bid. So expect high delivery volumes, and there is buying interest as well from large institutions. And the last is SJVN. It was part of my list few days back as well. Again, a very strong chatter of company likely to bag a very large order, and hence the volumes are on the higher side from larger HNIs in SJVN.
Okay, all right. Nimesh, thank you very much for that, for all the buzz and the chatter as always. We actually will quickly move on to Mitesh now, get some final trading ideas in before we get to the next story. Mitesh, so what final thoughts? Any new stocks coming up on the radar?
Yeah. So I think I have two stocks, and we've seen the market slightly come up, and I've been highlighting since last 2 days that could be a risk. But yet I think I would go with some BTST calls. NHPC for me is a BTST. Keep a stop below 89 for a target of around 91.5 or thereabouts. And the other one which I like is BTST on Popular Reality with a stop at about 1685 for targets of 1620, 1725.
Got that. Let's talk about Ola Electric. That's in focus after Maharashtra government's order on stores without trade certificate. How does this impact Ola? Sudarshan now joins in for more. Sudarshan.
So there is another update related to trade certificate issue of Ola Electric. Now CNBC-TV18 has accessed the letter written by Maharashtra Transport Joint Commissioner, and he has written a letter to local authorities asking the closure of all the showrooms that are operating without trade certificate. So the letter, it's been mentioned in both versions, English and Marathi versions, and the numbers that Maharashtra Transport Department has given in both the releases differ, but we are going with the numbers that they have given in the English version of the release. And it says that 107 of 131 stores of Ola Electric in Maharashtra are operating without trade certificates, and as of now they have closed 43 stores, and also they have seized vehicles, and the number is more than 200. Exactly, it is 214. The letter says that most showrooms and service centers are operating without trade certificates, and data that has been received so far shows that showrooms operating without trade certificates have not been closed, and that's the reason Joint Commissioner has asked local authorities to make sure those stores and service centers are closed immediately, and also login ID of all those centers operating without trade certificates has to be collected within 1 day. CNBC-TV18 has spoken to Maharashtra Joint Commissioner, Transport Commissioner, and he has said, as per rules, stores cannot operate without trade certificates, and he has asked reply from Ola Electric, and once the company replies, those replies will be examined and further action will be taken accordingly.
Okay, all right, Sudarshan, thanks very much for that. Going has been really tough for Ola Electric. Can you imagine the 52-week high for this stock? 52-week high for Ola Electric many months back was about 155 rupees. From that level, the stock's now come down to just about 50 odd. So tough going for investors here. That's Ola. However, let's talk about something that's at the other end of the spectrum. One part of the market that's been rock solid, rock steady and sizzling most of the time. We're talking about wealth management. By the way, before we talk about what the management said, let's pull up the stock. Look at 361 Wealth Management now, 6% higher. Serious momentum in the wealth management stock space. And it's not alone. Angel is picking up. Motilal is picking up. Even Nuvama is now positive. Nuvama is up about 1%. So the chase for wealth management stocks is on. And these are still off 20 to 30% off their all-time highs, most of these stocks in the market correction. So what's the story here? The big deal of the day, obviously, is 361 Wealth Management with UBS. The stock has been moving higher after the company announced a strategic collaboration with UBS. And as a part of this deal, 361 Wealth Management will be issuing warrants to UBS on a preferential basis. Now, this will result in UBS picking up about a 4.95% stake in this listed entity, that is 361 Wealth Management. And it's happening at a premium price as well. The price at which this deal is happening is 1,030 rupees a piece. So the warrants can be converted into an equal number of course, equity shares within 18 months from the date of allotment. We caught up with Karan Bhagat of 361 Wealth Management as well as Ginny Young of UBS Global Wealth Management today to understand the strategy behind this collaboration. Take a look.
I think most importantly what it gets to us is widening the platform for the client. And that's really what I think comes core to the culture of both UBS and 361, is to serve the clients in the best possible way. as a deep sign of, I think, collaboration. I think both UBS's investment into the equity warrants in the business, as well as our partnership in terms of, or our collaboration in terms of looking at the Credit Suisse and UBS business folding into our business, should add a lot of value to both our clients.
First of all, we want to bring this word global to the next level. So this transaction basically combines the global and regional reach capabilities of UBS, combining it with the reach and the capabilities of the local 361 India franchise. And this really, we believe that we are best placed to actually serve our global Indian clients, both domestically and also globally. That the wealth management, scene in India is really, growing at an exponential rate. And simply put, right, we really want to have a piece of the pie too. As you can see, these three components add together. We are really intertwining together our capabilities and making sure that we are able to serve our clients, global Indian client wealth management, in the most holistic way.
Okay, Post, that's the big deal that's taking place in the wealth management. Talking about the corporate earnings today, on the deck will be HCL Tech, that reports numbers later, and the key to track will be the FY26 guidance. Now, towards the end of March or early April, the guidance set was about 2 to 4%, 3 to 5%, but anything which is up to, say, 1 to 5% would be par for the course. But what we saw with the case of Infosys is that despite the company reporting a lower than expected guidance of 0 to 3%, investors still liked it because, for one, they gave a guidance, and two, they believe that it's not as bad as what the worst case scenario would have been. So watch for the FY26 guidance. As I said, 1 to 4, 2 to 5% should be perhaps in line with street expectation. Margin guidance for HCL Tech likely to remain unchanged at 18 to 19%. Now on to the top line. Revenue for HCL Tech is likely to decline quarter on quarter. We've seen even for the rest of the IT companies, whether it's Wipro, TCS or Infosys, the top line had declined. One, on account of seasonality. Two, the macro got tougher towards the end of the quarter. And for HCL Tech in particular, there was this large retail client whose project came to an end in Q3. So sequentially, that would have an impact. Margins too for HCL Tech would decline sequentially quarter on quarter to 18.1%. One, negative operating leverage. Two, wage hikes. And three, some visa costs. But focus on the commentary, focus on the FY26 guidance. That is going to be the key to track. But let's invite Jay Bala of cashthechaos.com on the show now. Jay, afternoon, and thanks for joining in. Today is a quieter session. We've had 4-5 solid days on the trot. Today, markets seem to be consolidating. What have you made of the day so far?
Hi, Emma. Good to be here. See, the more important what I've made of the day, it's more important what I've made of the recent couple of weeks. For the first time in several weeks, there's a bullish case for the markets for the medium term. And if this is the start of the bullish move or the resumption of the uptrend that started from the pandemic low, and we take the decline from the September high to April low as a correction, we could possibly be thinking of something like 29,000 to 35,000 on the Nifty over the next 12 months time frame. But this comes with an important, extremely important caveat. Reliance Industries, Nifty IT index are strongly disagreeing with this view. So, whether you're going to be long or short from this point onwards, you need to keep hedges from this point going forward. That even the bullish case is not all clear because of this. Even HDFC Bank, for that matter, is actually coming to likely an important top that's coming up at 1950. If HDFC Bank sinks back into its previous range of about 1880, sub 1900, that will probably signal this is a bull trap. But as I said earlier, for the first time in several weeks and several months, there has arisen a very bullish case for the markets.
And your bullish case, Jay, is leading you to believe in about 12 months, if the bullish case works out, we could be 29,000 to between 35,000 on the Nifty.
That's right. And
but do you? I mean, it's all about probability, right? The probability is higher because that's how you got to decide. Or you think, because I remember speaking with you and you saying either it's this or that. So it's kind of extreme on both sides. So are you still in that situation, or you think that on balance the probability of the market moving up in this fashion as you're describing is more now?
See, I would give the bullish case a very slight edge. I would say something like 60-40 for the favoring the bullish case. See, the problem with the markets is that if Reliance alone had been painting a downtrend for the slightly medium term, then the markets have done without Reliance. Like between 2008 and 2015, Reliance was flat for 5 years, and the rest of the market did okay. But this is doing along with the Nifty IT index and along with a possible top for the for the HCL Bank, which is now the private sector bank, which are giving the lift to the markets. And in the global space, the US techs, the mega techs, and the Nasdaq Composite are signaling a downtrend. Even there is indecision. The Dow is actually raising a bullish potential. So that's the reason why I'm saying you can do three things here. One, you can be bullish, bearish, or you can be the hedges. I'm very comfortable doing nothing. That's very few people are comfortable doing. And whatever I'm doing, it's in my trading account, not in my investment accounts. I'm keeping my trading account active, the investment account silent.
Got it. Ajay, just stay on. I think we have the US Vice President speaking at that public event in Jaipur on his India visit. Let's listen into what Mr. J.D. Vance is saying.
Inspires remarkable loyalty because of the strength of his belief in his people and in his country. Now, we're so grateful for Prime Minister Modi's hospitality as well as the reception that he and everyone else in this country have given us on this first trip for me to India. This is my first time visiting the birthplace of my wife's parents, and she's, of course, in the front row there. There you are, Usha. Thank you. She's a bit of a celebrity, it turns out, in India, I think more so than her husband. But I haven't been here long, but already I've been fortunate enough to visit the Akshardham Temple. Did I pronounce that right, honey? I did okay? All right. With my family this morning, as a matter of fact. And last night, Prime Minister Modi welcomed me, Usha, and our 3 small children at his beautiful home. I've been amazed by the ancient beauty of the architecture of India, by the richness of India's history and traditions, but also by India's laser-like focus on the future. And those things, I think this appreciation for history and tradition and this focus on the future is very much something that I think animates this country in 2025. Now, in other countries I've visited, it sometimes feels like there's a flatness, a saneness, a desire to just be like everyone else in the world. But it's different here. There's a vitality to India, a sense of infinite possibility, of new homes to be built, new skylines to be raised, and lives to be enriched. And there's a pride in being Indian, a feeling of excitement about the days that lie ahead. Now, it's a striking contrast with too many in the West, where some in our leadership class seem stricken by self-doubt and even fear of the future. To them, humanity is always one bad decision away from catastrophe. The world will soon end, they tell us, because we're burning too much fuel or making too many things or having too many children. And so, rather than invest in the future, they too often retreat from it. Some of them pass laws that force their nations to use less power. They cancel nuclear and other energy generation facilities, even as their choices, the choices of these leaders, lead to more dependence on foreign adversaries. Meanwhile, their message to their friends, to countries like India, is to tell them that they're not allowed to grow. Well, President Trump rejects these failed ideas. He wants America to grow, he wants India to grow, and he wants to build the future with our partners all over the globe. And when I look at this audience, or when I visit this incredible country over these last couple of days, I see a people that will not be held back. Now, the most profound responsibility I believe that all of us have is not to ourselves, but to the next generation, to make sure we leave them with a better society than the one that our parents and our grandparents gave us. And this is the world that America seeks to create with you. We want to build a bright new world, one that's constantly innovating, one that's helping people to form families, making it easier to build, invest, and trade together in pursuit of common goals. Now, I believe that our nations have much to offer one another, and that's why we come to you as partners looking to strengthen our relationship. Now, we're not here to preach that you do things any one particular way. Too often in the past, Washington approached Prime Minister Modi with an attitude of preachiness or even one of condescension. Prior administrations saw India as a source of low-cost labor on the one hand, even as they criticized the Prime Minister's government, arguably the most popular in the democratic world. And as I told Prime Minister Modi last night, he's got approval ratings that would make me jealous. But it wasn't just India. This attitude captured too much of our economic relationship with the rest of the world. So we shipped countless jobs overseas, and with them our capacity to make things, from furniture, appliances, and even weapons of war. We traded hard power for soft power, because with economic integration, we were told, would also come peace through sameness. Over time, we'd all assume the same sort of bland, secular, universal values, no matter where you lived. The world was flat after all. That was the thesis, and that was what they told us. And when that thesis proved false, or at least incomplete, leaders in the West took it upon themselves to flatten it by any means necessary. But many people across the world, and I think your country counts among them, they did not want to be flattened. Many were proud of where they came from, their way of life, the kind of jobs they worked, and the kind of jobs their parents worked before them. And that very much includes people in my own country, the United States of America. Now, some of you are aware of my own background. I actually didn't plan to talk about my background at all until last night at dinner, while my children mostly behaved. We gave them an A- for behavior with the Prime Minister. The Prime Minister said, I have one request. I want you to talk a little bit about your background. And so I wanted to do that. For those of you who don't know anything about me, I wanted to talk about it. I come from, and I'm biased, the greatest state in the Union, the state of Ohio, a longtime manufacturing powerhouse in the United States of America. My home specifically is a place called Middletown. Now, it's not a massive city by any means. It's not Jaipur, but it's a decent-sized town and a place where people make things, which has been a point of pride in Middletown for generations. It's filled with families like my own, some of whom called us hillbillies, Americans who came down from the surrounding hills and mountains of West Virginia, Tennessee, and Kentucky to cities like Middletown in pursuit of the manufacturing jobs that were creating widespread prosperity for families all across America. They came to Middletown in search of what we call back home the American dream. In Middletown, my parents raised me. My grandparents raised me. They taught us to work hard, they taught me to study hard, and they taught me to love God and my country and always be good to your own. My granddad, who I called Papaw growing up, he typified that. Late into life, he worked as a steelmaker at the local mill, and I know India has a lot of those. Papaw's job gave him a good wage, stable hours, and a generous pension. All that allowed him to support not just him and my grandmother, but his own daughter and grandkids with him. Now, by the time I came around, money was awfully tight, but he worked hard to make a good living for all of us. Now, I know Papaw and Mamaw were grateful for the way of life their country made possible. Their generation bore witness to the formation of America's great middle class. And by creating an economy centered around production, around workers who build things, and around the value of their labor, our nation's leaders then transformed their country and made thousands of little Middletowns possible. The government supported its labor force. We created incentives for productive industries to take root and struck good deals with international partners to sell the goods made in the United States of America. But as America settled into world historic prosperity it generated, our leaders began to take that very prosperity and what created it for granted. They forgot the importance of building, of supporting productive industry, of striking fair deals, and of supporting our workers and their families. And as time went on, we saw the consequences. In my hometown, factories left, jobs evaporated, America's Middletowns ceased to be the lifeblood of our nation's economy. And the United States, as it became transformed, those very people, the working class, the background of the United States of America, were dismissed as backwards for holding on to the values their people had held dear for generations. Now, Middletown's story is my story, but it's hardly unusual in the United States of America. There are tens of millions of Americans who, over the last 20 or so years, have woken up to what's happening in our nation. But I believe they woke up well before it's too late. Now, like you, we want to appreciate our history, our culture, our religion. We want to do commerce and strike good deals with our friends. We want to found our vision of the future upon the proud recognition of our heritage rather than self-loathing and fear. I work for a president who has long understood all of this, whether through fighting those who seek to erase American history or in support of fair trade deals abroad. He has been consistent on these issues for decades. And as a result, under the Trump administration, America now has a government that has learned from the mistakes of the past. It's why President Trump cares so deeply about protecting the manufacturing economy that is the lifeblood of American prosperity and making sure America's workers have opportunities for good jobs. As we saw earlier this month, he will go to extraordinary lengths to protect and expand those opportunities for all Americans. And so today I come here with a simple message. Our administration seeks trade partners on the basis of fairness and of shared national interests. We want to build relationships with our foreign partners who respect their workers, who don't suppress their wages to boost exports, but respect the value of their labor. We want partners that are committed to working with America to build things, not just allowing themselves to become a conduit for transshipping others' goods. And finally, we want to partner with people and countries who recognize the historic nature of the moment we're in, of the need to come together and build something truly new, a system of global trade that is balanced, one that is open, and one that is stable and fair. Now, I want to be clear, America's partners need not look exactly like America, nor must our governments do everything exactly the same way. But we should have some common goals, and I believe here in India we do, in both economics and in national security. And that's why we're so excited. That's why I'm so excited to be here today. In India, America has a friend, and we seek to strengthen the warm bonds our great nations already share.